And that's why I think even with Bitcoin, I would say if you're not ready to hold it for 10 years, don't hold it for 10 minutes. Like I would prefer, if you look at me and said, I really need the money in the next 4 years, I would say.
In the world of finance, risk and reward are two sides of the same coin. Most people run from risk. They try to eliminate volatility to make things stable, predictable, and comfortable. But Michael Saylor, the billionaire founder of MicroStrategy and one of Bitcoin's loudest advocates, sees the world very differently. For him, volatility isn't something to fear, it's vitality, it's life. In this video, we dive deep into Saylor's mindset, what it really means to hold conviction when billions of dollars are on the line, how to handle emotional pain after financial loss, and why most corporations are designed to slowly die. Michael Saylor begins with brutal honesty. It's not the money that hurts when things go wrong, it's the people. When a company's stock crashes, the CEO might lose numbers on a screen, but employees lose their livelihoods. Small investors lose savings. Families lose security. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
It's really stressful and unpleasant because you think about all the other people that you let down. Right? I mean, it's the shareholder. If you have that change, that's in a public company, right? The public stock crashes, and you think about the shareholders and the employees that are affected by it and their families, right? And so, I mean, the truth of the matter is, if you have $1 billion and you lose $6 billion, or if you have 100 million and you lose $6 billion, if you have 10 million, you lose, you know, your lifestyle isn't changing one way or the other. At some point, you know, these are just numbers that move back and forth. But the people, like, you know, the people that are the small investors or your employees, their life is changing. So the hardest thing about it is knowing that they're not going to have money they thought they had, or if you have to lay off people, or someone that it's particularly brutal if someone invests in you and they trusted you and you feel like you let them down, or you did let them down, right? So I think that's the emotional toll on that. And I mean, to this day, like, people ask me, you know, what about, should I buy MicroStrategy stock? And I don't want them to. Like I would never recommend anybody to buy it, because you might buy it and it might trade down 10%. You might feel like I let you down. Oh, I don't want you to rely upon me. I'm like, do your own research, make your own decision. It's very risky, right? Like, It's volatile. And that's why I think even with Bitcoin, I would say if you're not ready to hold it for 10 years, don't hold it for 10 minutes. Like I would prefer, if you look at me and said, I really need the money in the next 4 years, I would say, definitely don't buy it. I mean, it's reasonable. No one's ever lost money holding it more than 4 years, but really your attitude ought to be, it's a 10-year investment. I'm going to buy it and hold it. And if you don't have that attitude, what you ought to do is not buy it. What you ought to do is spend more time until you get the conviction that you're ready to hold it for 10 years. Just invest money reading and thinking, and otherwise don't, because I don't want to be the guy that said Bitcoin's good and it trades down 17%, and you tell me that, you know, your family's bankrupt because of it. I'm going to tell you a true story. I'm with a friend of mine in Vegas, and he's a big gambler. Okay. And so he'll go sit at the table and he'll say, give me $50,000 in chips. You know, we sit down at the table. He's got $50,000 in chips. I have $500 in my pocket. I'm like, I don't have any money. It's like, it's okay, I'll spot you here. Take 10,000. We're going to play. And we start playing, and we're playing multi-$1,000 hands. Okay. And the truth is, I would have a hard time just gambling $50,000, going up and down $10,000. He has no problem at all. But I have no problem at all having $1 billion bet and having it trade down $300 million, or a $15 billion bet and having it trade down $3 billion doesn't bother me in the least. But I would not gamble $30,000 in chips on a blackjack table. That would just drive me bananas. So the truth is, you could imagine that it would bother me. It doesn't. And here's why. It's because the gambling table, I feel like the odds are stacked against me, and the house is going to win, and it bothers me that I'm playing a game that's stacked against me. But with Bitcoin, I feel like the odds are way in my favor. And, at some point, 18 months ago, we had $2.5 billion of Bitcoin, and we had, $2.5 billion market cap or something like that. And everybody else is freaking out. I'm not freaking out. Bitcoin traded from 66,000 to 16,000. People said, what are you going to do? I'm like, well, I'm going to wait for it to go back up again. Right? It's been oversold. It's going up. My view is it's going up forever.
In one powerful story, Saylor recounts sitting in a Las Vegas casino with a friend, a high roller. His friend sits down, drops $50,000 in chips, and starts playing multi-$1,000 hands of blackjack. Saylor, meanwhile, has only $500 in his pocket.
If you owned Central Park in Manhattan, for hundreds of years, and someone said, well, there's a war. I hear that the price of real estate in Manhattan just dropped 30 or 40%. What are you going to do? I'm here forever, right? I'm not selling. I don't need to sell. I'm just waiting for the world to rationalize. So it's not really stressful. In fact, there's a subtle point to be made here. MicroStrategy's attribute is that it's volatile. Like, the reason that we're able to raise billions of dollars of capital is because we're more volatile than Bitcoin, and Bitcoin is more volatile than the S&P index. So that's actually an attribute. It makes the options valuable. That's why there's $30 billion or more of options trading in the options market, because if there was no volatility, the options are worthless. And if the options are worthless, we can't raise money. So we can go to the market and raise $1 billion and pay 60 basis points or 70 basis points. I can borrow money for 0.5%. You probably can't borrow $1 billion for 0.5% interest. I can borrow it for 0.5% interest for 6 years. Okay? And so you're going to say to me, are you bothered by the swings? No, I'm aware that because of the volatility, I'm able to sell a convertible bond that's got a 7-year duration or a 7-year duration and pay 80 basis points interest. That's no recourse, unsecured, right? Which is, and if I didn't have the volatility, if it went away, I would pay 10% interest. And by the way, I'd have to pay 10% interest, and I would only be able to borrow about 1/4 as much money. You have to embrace the volatility in the same way that you get out in the ocean and you put up the sail, and the ocean kind of does this to you, and this is your cabin. And you're like, are you bothered by the motion? And I'm like, well, the alternative is get out and swim.
Yeah.
But it's still not good. The truth is, I'm not going anywhere if I don't accept the volatility. And there's a difference between volatility. Like, MicroStrategy had $500 million of cash it didn't need and no volatility 4 years ago. Today, MicroStrategy has $14 or $15 billion of Bitcoin, $3 billion or $3.5 billion in debt. So it's like plus $12, $13 billion of assets it doesn't need. What difference does it make whether the amount trades up $1 billion a day or down a day? It's $1 billion. When Bernard Arnault goes from being worth, $180 billion to $160 billion to $120 billion to $200 billion, do you think it bothers him? Does it change his behavior? The reason he's successful is laser-like focus on the luxury business. Mm-hmm. Right? It's like that's just an artifact of it, and we can make that volatility go away. You know how we do that? We just give away all the money. Like Bernard Arnault could just give away all the stock and he wouldn't have any volatility. In MicroStrategy, if we gave away the $15 billion, we wouldn't have any volatility. But volatility is vitality. It's life, right? So you're better off. You do bring up an important point, which is conventional wisdom in corporations is volatility is bad and capital is toxic. So most corporations in the world, what they do is they say we have to give the capital back to the shareholders because holding it as debt is obviously destroying shareholder value, right? You notice the big buyback at Apple, the big buyback at Facebook, the buyback at Google, the buybacks, the capital is toxic. It's like, I want to get rid of it. Why is money a bad thing? Think about it for a second. because you've got to invest in the wrong asset. You've got the wrong kind of money. You're holding 100 billion of pesos, it's going to zero. If you're holding 100 billion of Bitcoin, it's doubling in 3 years, right? So the capital is toxic, so they decapitalize, which is pernicious. And the other thing is volatility is toxic, and so they want to get rid of volatility. Microsoft sells contracts 3 years in advance, like a 3-year enterprise agreement. Like, you know, I just want long-term rental contracts. Like, I want you to agree to buy the same thing from me for the next 3 years with the CPI escalator, and that way there's no uncertainty. I mean, the issue is if there's no volatility on the P&L, there's no volatility on the balance sheet, and then if I want to evaluate the stock, I can look at it once a year, put a price on it, buy, and snooze on you for the next 364 days, right? I mean, what's going to happen? Nothing. Well, if nothing happens, the options are worthless. You're not going to trade the options. That means you're not going to trade the underlying equity. That means the stock options for the employees become worthless. So how can you succeed, you know, if you have no capital and you have no volatility, right? And the answer is you're just going to have to work yourself to death. If you can't grow your revenues 15% a year, then you're going to fail. And so in that case, that explains why most corporations have a life expectancy of 10 years. They're all dying in 10 to 15 years because they have toxic capital and they have dysfunctional financial strategies. And so these things that other people want to run away from, I think you should be running toward those things.
That's why, he says, most companies have a lifespan of 10 to 15 years. They die not from risk, but from avoiding it. The paradox is clear. In trying to escape volatility, they escape vitality.